Hi, and welcome to our end of January update from the Wealthy Doctor Institute, physicians leading physicians through finance. We work with physicians and other busy professionals who are not happy with their current investment strategy. We help them get this part of their lives handled so they feel empowered and in control. I'm David Ye, and in my book, The Busy Doctor's Investment Guide, I show you just a few ways where just a few adjustments each year can help build and protect wealth. Although the strategies in this book are easy to calculate each month, for those who are new to the concepts in the book, or for those who are new to investment in general, this video will try to clarify what I do every month. Feel free to follow along every month until you get the hang of it. So for this month, we'll have the Busy Doctor's Update of the Month, Topic of the Month, then we'll review our systems starting with a 20-month moving average system, review our MRI system, review the rules of the 25% stop loss system, for if you really have to buy a certain individual stock for some reason, and then monitor the free sector server strategy that comes when you sign for Sector Server. So, day in the life of a busy doctor. So even though I semi-retired 5 years ago, life continues to be busy. And here's a welcome to all our new followers from when I met you at the last Society of Nuclear Medicine meeting in Orlando. But yes, despite the busyness, I still easily place the trades indicated by my systems. They literally require mere minutes to see and execute. And yes, this video is a little bit delayed this month, and that's because just at the end of the month, we've had a death in the family. So here's a moment of respectful silence for my uncle Chun Chi-ye. He's my mom's little brother, father of great cousins. He was 74 when he died. The death was sudden and unexpected. However, thankfully, doesn't seem like he suffered too much at the end. But maybe this is the appropriate time to start talking about topics that we tend to often tiptoe around, and that is, at least in finance, I've been meaning to talk about life insurance. Now, disclosure, I do have an Illinois insurance producer's license. However, I do not sell insurance, nor do I receive fees for referring clients to insurance agents. So interpret that how you would like. I do hold a certain amount of expertise to hold an insurance license, and my advice may be more objective if I have no financial gains either way with insurance. However, people can probably point out the fact that my level of expertise would not be at the same level of someone who deals with insurance every day. Fair statement. Having said that, let's drill down. In the financial world, there are three industries that control how we deal with money. We have the banks, we have Wall Street, and we have the insurance industry. And even though they all deal with finances and money, they're all regulated by different government regulatory agencies, and they all have certain things they are and are not allowed to say. So, for instance, insurance agents aren't allowed to say investments. Wall Street is. However, Wall Street is not allowed to say guarantee. Insurance is allowed to say guarantee. So, for instance, if you go to one of these hybrid banks, like for instance, I'm not picking on any particular institution, but if you go to Bank of America, which merged with Merrill Edge, if you talk to one guy, they have to disclose that they work on banking side, blah, blah, blah. And then if you talk to someone else, they have to disclose they work on the broker side and disclose blah, blah, blah. And now you know why. So when I was in private practice, and even when I was in residency, I was bombarded by financial advisors, some of which would be brokers, some of which would be insurance agents, and it would be very confusing talking to them because they all be speaking different languages almost, and trying to get a big picture out of what they were offering was pretty frustrating because of these gag rules that they all have to work under. I'm not saying that they're purposely trying to obfuscate, although it would be in their best interest to position their products in the best light possible while disparaging other products. But you can see why trying to make sense of the whole industry is challenging. So here's my attempt at trying to clarify. Properly utilized, each branch actually has a critical role in our financial health. But only one can guarantee anything, such as lifetime income. So having said that, when you take a look at insurance, the types of insurance that we typically deal with as consumers, we have life insurance, disability insurance, casualty insurance, namely home, auto, renters, and umbrella insurance, and annuities. I can go into a whole lecture on each one of these, but I'll stick to life insurance right now. And in terms of life insurance, you basically have two types of insurance. You have permanent life insurance, which protects your dependent or loved ones if you die too early. And you have annuities, which protect your income if you live too long. So just like how in the stock markets we try to mitigate our risks to try to avoid as best as we can the big downsides while still protecting our upsides, this is what insurance is trying to do in terms of our longevity risk. And then when we talk about life insurance itself, we have permanent life insurance versus term insurance. You've probably heard at least about one or the other by now. Term insurance pays your estate if you die. Permanent insurance pays when you die. Big difference. So like for instance, term insurance may cover you 5, 10, 20 years. You pay a little bit of premium, and if you happen to die within that time frame, then the insurance company pays your estate what it's promised to pay. Now, interesting note, people who tend to buy term insurance tend to outlive their term insurance. And that's probably because people who are responsible enough to buy insurance to begin with probably also responsible enough to take care of themselves. Whereas with permanent insurance, we're all going to die eventually, unless we find the cure for old age. It's a 100% chance that we will all die eventually. So that's why permanent insurance is so much more expensive. And I'll get into that a little bit more later. In terms of permanent insurance, there are many types of permanent insurance. There's whole life, variable, universal variable life, some of which are hybrid investments tied up with insurance. But for the purpose of discussion, we'll just stick with whole life. It's a much simpler discussion. I'd rather deal with insurance for insurance sake rather than trying to deal with as a hybrid, and I'll explain to you why. Now, a quick aside about life insurance, especially about the debate between permanent and term insurance. First of all, these two camps, you have the permanent insurance guys, they keep touting why the need or desire to leave a death benefit doesn't always go away, no matter how old or unhealthy you are. The cash value component is a flexible financial tool that can be used while we're still alive. And that's true. Then you have the term insurance guys who say buy term, invest the difference, because they say how permanent insurance is so expensive, particularly during the early years, during the first few years that you own the insurance policy, and how when you do eventually accumulate cash value, the growth of the cash value is not growing sufficiently to justify its cost. Now, if you talk to any one of these proponents, it's almost like a religion. They're all fire and brimstone about their side and trying to get objective about the strengths and weaknesses of each is a little bit difficult. But I'll present my point of view again. Motives matter. And again, I do not sell insurance nor receive fees for referring clients. Just like how when you go to a doctor's visit, if your physician recommends that you go see a cardiologist or go to MRI scan, your physician doesn't get any fees for referring you. I work on the same model. So here's my understanding, and here are examples of how I actually use permanent insurance in my life to sculpt my financial stability. Now, normally when you talk about whole life insurance, you will be presented with a complicated looking table. And although I can spend a lecture just talking about how to read a table, we can boil it all down to this graph. I'm a radiologist. I like visual things like graphs. So you can think about if this is your age, and this is just a hypothetical, and this is a representation of cash, this red horizontal line would be the face value. In other words, if you were to die anytime along this line, this is how much the insurance company will pay your estate. Meanwhile, the blue line would be how much your cash value would be growing if you keep paying premiums. So you see how this works. The older we are, the more it costs to insure ourselves, because the older we are, the more likely we are to die. So the way the insurance companies get around this is that if they have you pay more premium and put premium into a cash value where they can guarantee a minimum growth rate, typically around 4%, then as the cash value grows, they only have to insure less and less as you grow older and older, until finally, when you grow to be 100, or in newer policies, when you grow to be 120, your cash value equals your face value, and that's when the life insurance company says, okay, you win, we'll just pay you the face value and we have no more obligation to you. Because at that time, you are literally uninsurable. And I'm just giving you two different examples of how face value can grow. The blue line is if you were to pay premiums every year until you're 120, and this green line is if you only paid premiums for 10 years with the same guaranteed rate of return, you'll still reach face value by the time you reach 120 years of age in this hypothetical example. Now here's where it gets contentious. The cash value. People who say buy term and invest the difference don't really say anything about what this cash value is all about. However, think about it this way. Cash value is value that you actually own. It's growing tax-free. In other words, any growth on this cash value isn't taxed to you unless you take out cash value, which I do not suggest that. And the cash value is credit protected. Now, another caveat, talk to your estate planning lawyer in your particular state. But in general, if you ever face bankruptcy, which would be the logical conclusion of a successful lawsuit against us, and we have a 97 to 100% lifetime chance of being sued as physicians, if you talk to estate planning lawyers, they may agree that two sources of funds that are generally unreachable are retirement funds, such as your 401k, IRA, and your insurance products, such as the cash value in your whole life insurance or your annuities. Another benefit for people who have kids and you're thinking about funding for college. Now, rules can change, but as of right now, when colleges are trying to figure out financial aid, they do not count funds within your retirement account or within your life insurance policy. So, great. You have this cash value, but you cannot withdraw it. So, what's so good about it? Well, here's what's so good about it. You can borrow against your cash value, and because it's a loan, it's not taxable. And the insurance company is willing to lend you against your cash value because when you die, whatever they pay out in face value, they'll pay off the loan first and then your heirs get the rest. So because this is a loan that is backed by a guaranteed asset, this loan doesn't go against your FICO score. So let's think about this. We've been talking about the three bucket system. The security bucket, where you have emergencies, fixed short-term goals. Then you have the growth risk bucket, and then you have the dream bucket. We've talked before about how financial life is a balance of these three buckets. Well, in my videos, when I talk about investment systems, no matter how safe I try to make those systems, if you take a look at those graphs wiggle. So by definition, it's a risk bucket. It grows and can grow faster than your bank account or the cash value in your whole life insurance. However, we still must consider it risky. Meanwhile, for your safety or security bucket, so far most people consider cash, or at least cash in a bank. And you know how much they give in an interest in cash in a bank. Plus also cash in a bank is not credit protected. In other words, someone sues you, they can lay claim on it if they're successful. Earnings in there are taxed. You get a 1099 at the end of the year. It gets counted for when you're planning for college costs. And there are several other nuances that can further scope your financial landscape, which I won't get into in this video. But here's a way that we can coordinate our risk and safety buckets. So I've shown this example before. You have twins, Connie and Sally. They both have $500,000 when they retire. And they're both taking out initially 5% of their account and increasing by inflation rate, 3% every year, until they either ran out or they reached 90. And with stock market return, assuming that they invest their entire nest egg into the stock market, Connie here starts withdrawing from year one, and after 20 years runs out of money. And that's because when markets go down and you're still withdrawing, you don't give your nest egg enough time to recover. Whereas Sally here doesn't withdraw when the markets go down. When the markets go up, then she takes out money. But wait a minute, if she doesn't take out money during the drawdown years, where do you get the money? Well, that's where the safety bucket comes in. Let's say you have a safety bucket large enough so that you can replace 1 year's worth of income or several years worth of income when you start withdrawing money from your risk bucket. Well, because you're giving your risk bucket time to recover, your funds actually last a lot longer. Now, you might hear terms to describe this phenomenon. You might hear something called a volatility buffer. Now, we can modify this in several ways. I've been teaching you ways to try to mitigate the risks in this column, but even if you were to suffer losses here when you're retired and do not have income from working anymore, at least you should have a safety bucket. And the safety bucket needs to be considered sooner rather than later. I know many people who first approach me, they ask about investing. And when they become clients, I always emphasize making sure that we have some kind of safety bucket in place even before we start investing. So now, when my uncle suffered his unexpected death, it just reminds me that you don't have to worry about being hit by a bus. Death can come from literally anywhere. You can have widespread metastases and not even realize it until you get on the operating table and they find out the true cause of your abdominal pain. Number one symptom of coronary artery disease is sudden death. Accidents still kill relatively young people. I'm not trying to be morbid. I just want to impress on you that life happens. And when you prepare for life, such as with insurance, it does more than just prepare for your eventual death. So moving on, let's review our systems. First, there's the 20-month simple moving average system, abbreviated 20-month SMA. The rules are simple. If the S&P 500 index fund is above the 20-month moving average, it's relatively safe to stay invested in the index fund. Otherwise, get out. The 20-month moving average is our safety belt. It only works if we watch it every month. So, for instance, here's our graph of the S&P 500 index. Lately, especially after their elections, it's been on a tear with hardly any blips. And last month was no exception. The VFI index, which is the S&P 500 index mutual fund by Vanguard, I use because it has the longest track record, ended end of the month at $260.92, and the 20-month moving average ended at $217.43. So just a quickie calculation, price divided by moving average, we get a 20% cushion. In other words, the markets are increasing so quickly now that it must drop at least 20% for us to meet criteria to indicate that the markets are dangerous enough to exit. So until the markets do cross below the moving average, right now it's still considered relatively safe to be in the market. Just keep in mind that if you do invest right now, you could lose up to 20% and still be considered safe. Now, you might be saying, well, 20% loss, that's not safe. And that's true. If you lose 20%, you must make 25% just to break even. And no system is perfect. We're not trying to protect every single penny. We're only trying to protect against the big bear markets. So if you see historically, sometimes there are whipsaws. You sell one month, buy the next. But the big bear markets are the ones we're trying to protect ourselves from. And in terms of protecting ourselves from the big multi-month or multi-year bear markets, a 20% loss is a small sacrifice to prevent a 50% loss, which would require 100% just to break even, which happened twice within the last 28 years. So observations for a 20-month moving average for this month, the indicator continues to signal relative safety in the US stock market. In fact, the markets have shot up so high that our cushion of comfort has increased to around 20%. Now, if you're trying to say, well, the markets are so high, now is probably a good time to sell, remember when you try to outguess the system? The markets can stay irrational longer than you can stay solvent. So, and believe me, this has happened to me before, when I try to second guess the system and I exit too early and the markets keep on going up for months or even years, then I start to second guess myself. And then emotions take over. The whole purpose of using a system to help guide our investing is to take emotion out of the markets. So here's Sector Server's Strong Guard Armor version. It's a more sophisticated filter than 20-month moving average. Again, flipping between the same S&P 500 index fund and the same bond fund. This month, it still signals as relatively safe to be in the stock market as well. And here's a Strong Guard indicator showing that it's still clearly within safety range. So the next system is the Monthly Rotation Investment System, abbreviated to MRI system. The rules are simple. Every month, rank, using dividend-corrected data, the three mutual funds, the S&P 500 Index Fund, the Emerging Markets Fund, and the Inverse S&P 500 Index Fund. Sell the bottom 25% of your portfolio and buy the top fund every month. So here's the mechanics of how we're doing this month. So here's the end of month last month, end of month this month. Subtract, divide, we see that the S&P 500 index went up 5.7%. On the other hand, the emerging markets went up 8%. In fact, the emerging markets were up at 1.10% and has been slowly drifting down to 8%. Meanwhile, the inverse fund has lost 5%. So now we have a clear winner. This month, it is still the emerging markets fund. So here's what our model looks like. Last month, we were 100% in the emerging markets fund. This month, we don't have a loser to sell because we're still holding winners. So we're still holding 100% emerging markets for this month. And here's the Sector Server version of rotating among these three funds. Sector Server is also 100% in the emerging markets fund for this month, and there is no signal to switch out. So the observations for this month. The markets really took off this month. January, the US stock market was amazing. Some people would be happy with that return for a whole year, let alone 1 month. The emerging markets were even more amazing. Since we're already 100% in the emerging markets, no adjustment is necessary this month for this particular system. Sector Server also continues to be in the emerging markets, but remember, Sector Server uses a different algorithm. Don't mix up the systems. And for people who say, well, it's too dangerous to put 100% into any one fund, well, yes, that's why we use systems to tell us when to get out. but that just means that we must honor the systems when the systems indicate that it is time to get out. And again, just because two different systems agree does not mean it's a sure thing. Markets can still always go against us in the middle of next month. That's why we keep watching this once a month. Each system has different criteria to exit and switch, so watch your systems. So next system is a 25% trailing stop loss system. It's a system that we use if we really want to buy a particular stock, individual stock, rather than a mutual fund or ETF. If you do want to buy a stock, limit the risk of that one stock to 1% of your portfolio or trading account. And here's how to do it. You can buy up to using 4% of your trading account on that one stock. If you were to put a 25% trailing stop loss order, if the stock drops 25%, you get stopped out. In other words, the system will automatically sell for you, and you'd only lose 1% of your portfolio's value due to that mistake. However, if the stock keeps on going up, in fact goes up 33%, then the stop loss has just broken even, and now you can buy another block of stock using another 4% of your account. And then, of course, update your trailing stop loss order to reflect the increased number of shares. If that one stock you bought really is doing gangbusters, you'll probably have to repeat this several times until you get stopped out. But if it doesn't, then you'll be glad that you did have at least a stop to help you get out when it became dangerous. Next system, your own sector surfer system. Sector surfer, I've described before. It's both a sector rotation system and a system to detect relative bull and bear market conditions, just like how I described with the 20-month moving average and the MRI systems, just with somewhat more sophisticated algorithms. So Sector Surfer has two main tools. It has the filter to figure out whether or not it's relatively safe or dangerous to be in the stock market, and then has sector rotation to optimize which fund or ETF within that particular phase of the markets has the strongest momentum. Having said that, remember when you're building your Sector Surfer strategy, don't just throw in funds and start using them. At least backtest. And it's a very simple one-click backtest available on Sector Surfer to see whether or not your particular combination of funds really do work the way you think it works. And part of that strategy is to make sure that you separate out both stock and bond funds from each other. Use the stock funds for when the markets are safe and use the bond funds when the markets are dangerous. That's just one nuance in constructing your strategies. Having said that, when you sign up for Sector Surfer, initially it's free. It gives you a free strategy which doesn't use these nuances. However, it does still use a filter to differentiate between safe for stock zones, which this month we're still in the safe for stock zone, and we're still in the Fidelity Large Cap Stock Fund as its fund of choice in that particular system. So here it is. Out of this universe of 5 stock funds, 1 bond fund, and 1 money market fund, right now we are still in the Fidelity Large Cap Stock Fund. So in summary, we introduced the basic concepts of life insurance in this month, and introduced a few ways how the cash value of the permanent life insurance can help stabilize our financial situation. Now, I just gave a quickie introduction. Used properly, life insurance can be a great tool for your safety bucket, of which I've given you a few examples how to use. Now, I'm not saying go out and buy life insurance right now. The quality of agents vary widely out there, and you will run into agents who just want to sell you as much insurance as possible. So litmus test would be to see whether or not that agent is familiar with some of these adjunct risk mitigating strategies that can be used while you're still alive. Then we went over our 20-month moving average system, our monthly rotation investment system, dealing with stock tips, and reviewed the sample-free Sector Surfer strategy this month. So keep those questions coming. I know I talk to several of you personally each month and realize that for some of you, these video updates are not enough, especially if you're still unhappy with your current investment strategy or lack of strategy. I'm going to offer a complimentary investment wellness checkup and breakthrough session for you. Just you and me. Ask all the questions you want, no matter how seemingly basic or clueless you think you are. In our checkup and breakthrough session, we'll together create a sense of clarity about your financial future you really want, the reasons why you're investing to begin with, and how to get you there, discuss the investing building blocks that are more specific for your own situation, determine what has stopped you in the past from you getting what you want now, identify what are the more important steps you need to take now to get to your investing and financial goals, and then complete our consultation with the excitement of knowing exactly what to do next to create that road to a financial future you really want. Think CME, only topic is financial and tailored to you. Think wellness checkup, because whether or not you feel financially well, if you had a financial cancer or a blind spot you didn't know about, wouldn't you rather at least know so you can deal with it before the problem grows and metastasizes? Don't be bashful reaching out. The more you delay, the more time is against you. So, until next month, invest safely.